Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Lumen Technologies stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Lumen Technologies is a telecommunications company. The company is headquartered in Monroe, Louisiana. It was founded in 1930. It went public in 1984 and currently trades on the NASDAQ. It offers communications, network services, security, cloud solutions, voice, and managed services. Its communication services include local and long-distance voice, broadband, Ethernet, cloud hosting, data integration, video, network, VoIP, and much, much more. Let's get started with the model. This is a large cap company. 15 billion market cap. They're trading at $14 a share and they have 1.1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see the company has a lot of free cash flow. Not so much in 2017, but a ton in 2018, 19, and 20. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's positive in 2017, a big negative in the other 3 years. Revenue is the sales for the company. That peaked in 2018 at 23 billion. It dropped a little to 21 billion in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit. And that peaked in 2018 at 12.5 billion. It's come down a little bit, but it's still pretty strong at close to $12 billion. Below that is operating expenses. Examples are depreciation and marketing expenses. Then below that is operating income. And their operating income peaked in 2019. It wasn't too much lower in 2018. So they're becoming more efficient. Even with lower revenue, their operating income was much higher than in 2018. Below that is the interest they pay in their debt. Then other income and expenses. And you can see there's a lot of negatives in other income and expenses. That's why they have negative net income. I would focus on operating income when I look at the income statement because the things below that are not part of their operational business and they're usually not recurring. This is their other income and expenses. This is 2020, 19, 18, and 17. The bulk of their other income and expenses are impairments of capital assets. So this means they're decreasing the value of an asset onto their balance sheet and then passing through the loss onto their income statement. They may have purchased a building or factory several years ago and the value of that building or factory is lower, so they're decreasing the value on their balance sheet. So it doesn't affect cash flow. It could be from a purchase that happened many years ago. You generally don't want to see a company decrease the value of their assets. But if I was investing in a company and they had negative net income, I'd feel more comfortable if it came from an asset impairment than it came from a negative from their operating income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Operating cash flow is a better indicator of a company's financial health than net income because net income is your accounting profit and loss. It's not cash. To find out how much cash the company generates or loses, you need to look at the statement of cash flows. So you can see the company is generating a lot of operating cash flow each year. It peaked in 2018 at 7 billion, but it's not much lower in 2020 at 6.5 billion. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow. And the company has a healthy amount of free cash flow each year, about $3 to $4 billion a year. It was lower in 2017 due to their low operating cash flow. They pay a little more than $1 billion a year in dividend payments. That comes from free cash flow. And if they want to pay down debt or buy back stock, that also comes from free cash flow. So it looks like they have a lot of extra cash remaining to do things with. In 2017, they took on a lot of debt, $8.8 billion, and they paid down $2 billion. They may have taken on this debt to help fund their dividend payment and also acquire another business. They did pay down about $1.8 billion of debt in 2018, and they paid down about $700 million in 2019. They paid down $3 billion of debt in 2020. So for the past 3 years, they're doing a good job at reducing their debt. Let's look at the capital structure. $11 billion of equity, $32 billion of debt. They're 26% equity, 74% debt, and their WACC is 7%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for. That's $37 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $34 billion. We divide that by 1.1 billion shares. And we get a calculated stock price of $31. They're trading at $14, so they're trading at a 54% discount. It's a strong buy according to the model. Simply Wall Street is a little higher than me. They're at $36, so they're also saying the stock is undervalued. The stock has come down the past 5 years. It looks like it was over $30 back in 2016, but it's been cut in half since then, sitting below $15. They've been cutting their dividend. It was 54 cents, it's down to 25 cents. That's probably to reflect the stock price. As the stock price comes down, your dividend yield goes up, so you can pay a lower dividend and have the same dividend yield. Their dividend payment is 7.18%, and to calculate the dividend payment, you could just multiply their last dividend by 4, take that number, and divide by the stock price. We cannot look at their payout ratio because they have negative net income due to that large asset impairment. But they do pay out 39% of their free cash flow, which means 61% is left over to pay down debt, buy back stock, or to reinvest back into the business to grow it. Their beta is 1.1, so the stock moves a little more than the market. It's not too volatile. The stock has gone up 34% in the past 52 weeks, while the S&P 500 went up 41%. The 52-week low was $8, the high was $16.60, and the stock is trading above its 50-day and 200-day moving average. This is a pretty liquid stock. 15 and 19 million shares are traded each day. Of the 1.1 billion shares outstanding, 989 million are on float, and a little more than 9% of the shares are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $7,600 today. The biggest shareholder is Vanguard at 11.5%. The next shareholder owns 9%, then BlackRock, Southeastern Asset Management, and last is State Street. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, we look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 0.7. That means investors are paying 70 cents for $1 revenue. That's a really good price to sales ratio. Price to book is stock price over book value per share. They're at 1.4. And to calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $11 billion of equity, negative $16 billion of tangible equity, because they have $27 billion of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 2.2 times. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They can cover 50% of their current liabilities with their current assets. And their current assets are $400 million of cash and $2 billion of receivables. So the company does seem to be undercapitalized. They had about $2.8 billion of free cash flow, negative $3.5 billion of working capital, and a $1.1 billion dividend payment. So they're short $1.8 billion. So they may need to take on some more debt over the next 12 months just to run their business. The best way to look at ratios to compare them to similar companies, I've done videos of 10 companies in the same industry as Lumen, and if Lumen has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they're negative. They have a really good price to sales and price to book, although they have negative tangible equity, so their book value isn't that great. They have a terrible current ratio, a bad ROE, they're high in debt, and they're a decent sized company at 15 billion market cap, but they're much smaller than the average of 84 billion, and they do pay a nice dividend over 7%. So to summarize, I have them trading at a 54% discount. This company has been around a really long time, so there's a lot less risk when you invest in a company that's over 90 years old. Of course, there's risk in any investment, and they provide a service that we cannot live without. Voice communication, internet communication, cloud computing, all that stuff is part of our everyday society. Of course, there's competition as well. You can't forget about that. I ranked their free cash flow 6 out of 10, their revenue 5 out of 10, and their ratio is 4 to 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.